So you're welcome again to another impactful and educative model. Um, I hope you guys enjoyed the last two modules, and I also hope you have gone ahead to practice and bulls and bears and the trading is all about practicing. Okay, so the more you practice, the better you become. Okay, so I want you guys to be intentional about identifying the bears and the bulls. So you could visit any broker and then check the trading platform and for their charts, the candlestick charts, and identify the bears, the bulls, the trending market, and the ranging market. Okay, so now today we're going to be talking about indicators. So this is I consider this to be the most important aspect of trading. It's actually the most important. It's the most critical aspect of any technical analysis. Okay, so indicators are like the life blood, the life wire of technical analysis. Without indicators, we have no technical analysis. So indicators are very, very, very important. They are very, very important in the toolbox of a technical analyst. Okay, so basically, indicators, as the name implies, reveal the direction, volatility, momentum, or volume of an asset. Okay, they reveal the direction, the volatility, the momentum or volume of an asset. So they are interpreted to provide subjective information guiding a buy or sell decision. Okay, so indicators, when combined well, can produce trading strategies with varying levels of accuracy. Okay, so basically, um, every trading strategy must have a combination of indicators, that supplement one another. Okay, so indicators can never work in isolation. Any indicator that is used in isolation will not produce um, accurate readings or accurate results. Okay, so always combine indicators that supplement each other. Okay, so if you are using a volatility indicator, you shouldn't combine two volatility indicators together on one chart. Okay, so it's best to combine volatility indicators with a momentum indicator and volume indicator, and a trend indicator. Okay, so indicators basically reveal the direction, whether uptrend or downtrend or ranging market. So they reveal the direction of the market. They reveal the volatility, the momentum or volume of an asset. Okay, and so technical analysts use indicators to derive or generate signals, buy or sell signals. Okay, so indicators, when combined well, can produce trading strategies with varying levels of accuracy. There is no holy grail indicator, right? Indicators all have strengths and weaknesses. Okay, so the indicators have strengths and weaknesses. Okay, so as we proceed, and you would realize that um, indicators, a successful strategy will have indicators that complement each other. Okay, so the major classes of indicators include trend indicators, e.g., moving average. We have the volume indicators, e.g., candlesticks. We have the volatility indicators, Bollinger Band, and we have the momentum indicator, relative strength index. Okay, so basically these are the four major classes of indicators, and a good strategy should have one representative from each of the classes. Okay, so let's move on. So every effective strategy should have all the indicators. Should have a trend, a volume, volatility, and momentum indicator. After years of testing and validation, Binary Options University has built a strategy with an accuracy of 90% using the Bollinger Band, the relative strength index, and candlesticks. Okay, so basically we have validated a strategy that wins 90% of the time. Okay, so we have a strategy, and I'm so excited about the fact that our students are already practicing the strategies, and they are excited about the strategy. They are using the strategies to make a decent amount of profits. Okay, so you being at this training, or you taking this course, um, is like a milestone, in your trading education, because at the end of this training you will be equipped with a strategy that is accurate, a strategy that is 90% accurate. Okay, so basically the strategy um, involves the use of the Bollinger Band, the relative strength index, and the candlesticks. Okay, so let's go to the Bollinger Band. The Bollinger Band is arguably the most effective indicator on the planet, considering its diverse features and functions. It doubles as a trend indicator and a volatility indicator. Okay, so the Bollinger Band is composed of a 14-day moving average and the upper lower bands, which are standard deviations of the 14-day moving average. The Bollinger Band reveals the strength of the trend and the momentum. Okay, so the Bollinger Band is a very effective indicator, and at Binary Options University you cannot find an instructor that doesn't use the band. Okay, so the Bollinger Band is our our primary indicator at the university. Okay, so the Bollinger Band is very, very important, and it's a prerequisite to mastering our hamster pattern. Okay, so the Bollinger Band is not just a volatility indicator, like we learned yesterday. The volatility indicator is an indicator that measures the rate of change of the price of an asset. Okay, so the Bollinger Band is a very good indicator for actually detecting or spotting unusual volatility or abnormal volatility. Okay, and so it's also very useful for detecting very low volatility, okay, as seen in a squeeze. Okay, so the Bollinger Band squeeze indicates periods of very low volatility, which should be avoided. Okay, so and also the Bollinger Band can be used to measure the volatility, excessive volatility during periods of impact news release or very high volume, periods of high volume. Okay, so it doubles as a trend indicator and a volatility indicator. Okay, so the Bollinger Band is not just a volatility indicator, it's also a trend indicator. That's why you have the middle band, the middle moving average, and the upper band, the lower band. Okay, if you take a closer look at the Bollinger Band, you realize that it has the middle line. The middle line is the 14-day moving average, which can be adjusted to suit your trading style. Okay, so but we advise our students to maintain a 14-day moving average on the settings. So do not change the settings. Leave the settings at 14 days moving average. Okay, and so the upper Bollinger Band is a +2 deviation from the 14-day moving average, while the lower Bollinger Band is a -2 deviation from the middle 14-day moving average. Okay, so the upper lower bands, which are standard deviation of the 14-day moving average. The Bollinger Band reveals the strength of the trend and the momentum. Okay, so the Bollinger Band reveals the strength of the trend and the momentum. Okay, so when you notice that the price or an asset is closing outside the Bollinger Band, you can actually deduce that the asset is trending and the trend is strong, either in an uptrend or a downtrend. Any close outside, when the price is closing outside the Bollinger Band, it's an indication of a strong trend, a strong momentum. Okay, so let's move on to the okay, so basically this is an example of a squeeze. You can see how the band starts from here, it moves here, it moves down, and then you see the distance between the upper Bollinger Band and the lower Bollinger Band, and then you can see the middle 14-day moving average. Okay, so this 14-day moving average, any close below this 14-day moving average is a clear indication of downward momentum. Okay, so in a downtrend, the price will occur below the moving average, the 14-day moving average. In an uptrend, price of an asset will open and close higher at the upper level of the 14-day moving average. Okay, so in an uptrend, price of an asset will open and close on a higher level, higher than the 14-day moving average. But in a downtrend, the price will open and close under the 14-day moving average. Okay, so but you can see this, price opens and closes on top of the 14-day moving average. Okay, so it's amazing. Okay, so let's move on. A ranging market. a ranging market. So we discussed the other day what a ranging market is. A ranging market is a market that has a price or an asset enclosed within the Bollinger Band. So you can see the price came down at this level here, at this level, and it could not close outside the Bollinger Band. Okay, so it went up, it tried, but you see there was a close outside the Bollinger Band, but almost immediately the price retraced and went back into the Bollinger Band. And look at this level also. Price could not close outside the Bollinger Band. It retraced back to this level. Price could not close outside the Bollinger Band. It went down, and at this level, price tried to close outside. It closed outside. There was one candle closing outside the Bollinger Band, but you see, almost immediately there was a retracement, and the Bollinger Band pushed the price back into the band. Okay, so you can see there's in a ranging market, price is enclosed. Price is enclosed within the Bollinger Band. So you can see the range in a sideways fashion, in a sideways movement. You can see from left to right, price is not making a lower low or higher low. It's just moving in a sideways fashion. Okay, so let's move on. You can see clearly that the Bollinger Band, the candles break out of the tag. The candles break out of or tag the upper or lower Bollinger Band in a trend. You say the price is tagging the upper Bollinger Band, and this is a clear indication of upward momentum. Look at this bullish candle breaking out of the Bollinger Band, which is an indication of strong upward momentum. It tells us that the buyers are pushing the price up. Okay, the bulls are in control. Okay, so this is basically a practical explanation or example of how the Bollinger Band can be used to determine the trend and the momentum of a market. A squeeze is formed when the market is experiencing very low volatility or inactivity. During a strong trend, the candlesticks will break out of the upper or lower Bollinger Band. The candles form within the Bollinger Bands in a ranging market. Okay, so I've discussed this. So let's move on to the candlesticks. Candlesticks are pictorial representations of the market psychology. They are also reactions at a given point in time. So candlesticks are representations, they are pictorial representation of the market psychology and reactions. And reactions at a given point in time. Okay? They basically convey a message of optimism, bullish candles, or pessimism, bearish candles. Okay? So when you see a candle that is bullish, you know that the market is optimistic. When you see a candle that is bearish, you know the market, there's pessimism surrounding that particular market, and that particular asset is not doing too well. So Candlesticks signal trend continuation, reversal, or indecision. The hammer, inverted hammer, shooting star, spinning top, hanging man, Marubozu, and star are the most important candlesticks for binary options trading. So these are the most important candlesticks, and so we'll be talking about all of them today. So the first candlestick we are going to be talking about is the hammer. The hammer. So you can see this is the hammer. This is the hammer. The hammer is a very strong reversal candle. Okay? So whenever you see the hammer after or during a downtrend, it's an indication that the market control is shifting from the bears to the bulls. Okay, so when you see a hammer, which occurs only in a downtrend. Okay, so hammers always occur during or at the end of a downtrend. Okay, so when you see a hammer, it is a sign that the bulls are about to take control. It tells you that the bulls are building momentum to push the price of the asset up. Okay, so you see the hammer is composed of a wick, the lower wick. Look at the lower wick and the upper body. And so the lower wick is about twice the size of the upper body. And you see the lower wick and the upper body. So this is the hammer. The hammer is a very strong reversal candlestick. The hammer is a very strong reversal candlestick. We have the shooting star. The shooting star. The shooting star is the inverted form of the hammer. Okay, so it occurs in an uptrend. Okay, so it occurs during an uptrend. Okay, so when you see the shooting star during an uptrend or after an uptrend, it's a clear sign that the bears are about to take control. They're about to take control. It's a sign that the bears are building momentum for a reversal. The bears are building momentum and the asset is about to experience a downward reversal. So you see it, the price moved up, the price of the asset moved up until here. When the shooting star formed, there was an almost immediate reversal. So you see, whenever you see a shooting star, it's very sure. You can be 100% certain that a reversal is very close. Okay, so and you see the wick must not be in the direction of the new trend or the retracement. The wick of a shooting star is facing the direction of the previous trend. Okay, you see, this is an uptrend Look at it. It's an uptrend. After the uptrend, you see, the shooting star formed, and the wick is not in the direction of the proposed reversal or the new trend. Okay, so you can see it. The body is facing the new trend, and the wick is facing the old trend. Okay, so the shooting star happens only in an uptrend. This is the shooting star. Very, very strong reversal candle or candlestick. The next one we're going to be talking about is the Marubouzu. The Marubouzu. The Marubouzu is a candlestick with a very full body, without a wick or with little wick. Okay, so it clearly shows that the momentum is very, very high, and the bears or the bulls are clearly in control. Okay, so but on this particular chart, you can see it that the Marubouzu shows that the bulls are in control. And look at it. Look at it. In a strong uptrend, the Marubouzu shows that the bulls are in control. The bulls are pushing the price of the asset up. You can see the strong, full candlesticks with no wick or with a little wick. This particular candle doesn't have a wick. So you see, this is a Marubouzu. This is a strong Marubouzu. The next one we're going to talk about is the star. Okay, so the star is resembles a mini Marubouzu. It's like half the size of a Marubouzu. It also shows that it can actually be a continuation signal or a reversal signal. Okay, so but when you see a star during an uptrend, it shows that price can either reverse or continue. So the star is not it cannot be used in isolation. The star can be a reversal or a continuation candlestick. Okay, so you always wait for a confirmation before you trade this. Okay, so another way you could trade the star is you have to gauge the momentum of the market. If you see a star after a divergence, it is a clear sign of a reversal. But the star is not as strong as the hammer or the shooting star. So this is the star. You look at the body, not really full like the Marubouzu. It's not as full as the Marubouzu, but you can see it. It clearly shows that the bears are not really fully in control, but they have some measure of strength in them. You know, it's not clearly a sign of dominion. It's not really a sign of dominion. It only shows that the bears are still in charge. Okay, but it can also reveal that it also reveals, this particular star reveals that the bears don't really have that strength in them. But you can see the size of the body. The size of the body, this particular body is not big. The body is not now you can't compare this to this. Okay, so the body is not as large as you would expect. You know, so this is This actually indicates that the bears, although they are still in charge, they don't have that, the momentum is not so strong. Okay, so this star can be a continuation or a reversal candlestick. So we have the inverted hammer. The inverted hammer is basically a hammer that is inverted and vertically. Okay, so the inverted hammer is also a strong reversal candlestick. So the inverted hammer occurs after a downtrend. It indicates that the buyers or the bulls are about to take charge or take control of the market. Okay. So the next one we're going to talk about is the hanging man. The hanging man. The hanging man is the shooting star. Is an inverted shooting star. Okay, so whenever you see an inverted shooting star, it's a shooting star that has been inverted. You know, it has been inverted or vertically. You know, so the hanging man is a vertical inverted shooting star. Okay, and so it also occurs in an uptrend. Okay, the shooting star occurs in an uptrend. The hanging man occurs in an uptrend. Okay, it is a sign of, the hanging man is a sign of a reversal. Okay, after an uptrend. So doji, we're going to talk of doji. I hope everyone is following, and I know at the end of today, you know, you would have learned something very, very pivotal to your success, because without the indicators, you cannot master any strategy. You know, so the indicators are the DNA of any strategy. Okay, so this is the doji. The doji is a sign of indecisiveness. It's a sign of indecision. It's a sign that the market is not decisive. It's a sign that the market is not decided as to the direction to go. You know, so it's a sign that, and it's not safe to trade in a market, in an indecisive market. You know, so when you see a market or you see an asset having too many dojis, is a sign that that particular market is not decisive. So it is high risk. It's a high risk environment. Okay, so you see too many doji, this one doji, you can see this is another doji over here. Okay, this looks like a doji, and it's like a doji. It's also like a spinning top. Okay, but it's closer to a doji. This is a doji here. This one doji. This one doji. This is another doji. Another doji here. 2, 3. 1, 2, 3. This is a doji, a doji, a doji, and so a doji is like a sign of the cross. A sign of the cross without anybody, or without a body, or with a small, very small, insignificant body. You can see the body is the open and the close is not really wide apart. You can see the size of the body is insignificant here. The size of the body is insignificant here. You see, it's the wick is very, very, very obvious. You know, the wick is very wide, but the body is very narrow. You can see the body of this candle, the body of a doji is not visible. Okay, so when you see a candle without a visible body, enclosed between a long, or in the middle of a long wick, you know, the body of a candle in the middle of a long wick, you know, that particular candle is called a doji candlestick. Okay, so let's move on to spinning top. The spinning top is like a twin brother of it's like the twin brother of a doji, but this particular candlestick has a larger um, body. Okay, so the spinning top usually forms in the middle of a wick. Okay, so the spinning top also it indicates a measure of indecision. You know, a spinning top, it tells you that at the time within this time frame, there was the buyers were in control, and also the sellers were in control at some point. Okay, so you see this upper wick. This upper wick tells you that there was a time when the bulls were in control. The lower wick tells you that there was a time when the bears were in control. So now they've reached a compromise. They reach a middle ground. Okay, so you see the price closed in the middle of these two levels. They're telling you that the bulls and the bears have decided to reach a compromise. Okay, so although the candle is indicating a bearish sign or a momentum, that momentum is very, very insignificant. You know, it tells you that the market is neither here nor there. Okay, so the market is indecisive, and so it is not safe to trade this pattern or trade this particular candle. Okay, so let's move on to the next indicator, and I think this is my favorite indicator. It's I can't do without this indicator. You know, the relative strength index, it's like a compass. It's like a compass showing you the way to go. You know, telling you the point at which the market is weak, revealing to you when the market is strong. And so when you know the market is strong, you can either make a buy decision, okay, or make a sell decision when the market is weak. Okay, so the RSI, the relative strength index, measures the strength of a trend and displays the reading as a line graph moving across the overbought 70 and oversold 30 horizontal levels. When the RSI graph crosses the 70 horizontal level, the asset may be considered overbought. A cross below the 30 horizontal level may be considered oversold. Okay, so the RSI is composed of two levels: the 70 level, horizontal level, and the 30 horizontal level. Okay, so most traders consider the 70 horizontal level as an overbought level. Okay, and they consider the 30 level as the oversold level. While this might not be might not be wrong. Okay, why this might not be wrong in entirety. Okay, but it's not accurate. It's not totally accurate. Okay, so it's not totally accurate to say the 70 is an outright overbought level. Okay, it's not totally accurate to say the 30 level is it's an oversold level. Okay. So, but what happens is this: when an asset is approaching the 70 mark, okay, there is a possibility of that asset rising above 70 to hit 80 level or 90 or 100. In situations when the fundamental driver is very, very exceptional, or the fundamental driver or the fundamental data is exceptionally good, the RSI in most cases will cross the 70 level and approach even 100. Okay, so it's not totally accurate to say that the RSI 70 level is overbought, because it's relative. It depends on the metrics and also the dynamics of that particular currency or stock or commodity. Okay, so you cannot generalize the level and say the 70 is an outright overbought or the 30 is an outright oversold. You know, so most of the time 70 is overbought and the 30 is oversold. But in some cases, you know, the 70 level, the asset will not reverse until it hits the 100 level. So if you are trading a reversal, you know, at the touch of the 70 level, you will lose most of the time. Okay, so if you are trading a reversal at the touch of the 30 level, you also lose money, because there are times when the price will shoot below or above the 70 level, and there are times when the price will fall below the 30 level. Okay, so when the RSI graph crosses the 70 horizontal level, the asset may be considered. May, not will. Okay, so it's a condition that cannot be used in isolation. You know, you cannot just generalize and say the 30 level is oversold or the 70 level is overbought. Okay, so it may be considered overbought after considering other factors, after considering the fundamental, after considering the divergence, after considering the confirmation candle, after considering the positional direction of the candlestick in the Bollinger Band. Okay, so you consider the location and the formation of the candlestick in the Bollinger Band. You cannot just take the 70 level as an overbought level and the 30 level as an oversold level. You cannot use it in isolation. This rule cannot hold in isolation. You must combine it with other indicators to reach a trading decision. Okay, a cross below the 30 horizontal level may be considered oversold. Rsi divergence occurs when the higher high, an uptrend of the candlestick chart, produces a lower high on the RSI chart. In a downtrend, the lower low of the candlestick chart produces a higher low on the RSI chart. Okay, so basically the RSI divergence is we consider it the most important parameter of the relative strength index. And this is one of the components of our pattern, of our strategy. The Rsi divergence is very, very useful and accurate. Okay, so the Rsi divergence is when you see the RSI overbought level, like I mentioned, the price did not reverse at the touch of this 70 level. The 70 level is this green line, this horizontal line. But this particular asset, at the touch of this 70 level, moved further up to this level. And so if you had traded a reversal at this green level, you will have lost your money, because at this particular point in time, the price went further to hit a higher level. Okay, so a divergence occurs when the lower high and the higher high does not correlate with the higher high and the lower high of the RSI. Okay, so every peak or every support or resistance level produces a peak on the RSI chart. Okay, so when the price moves up and retraces back down, you see the bulls are in control here and push the price to this level. At this level, the price did not move up again. The price retraced as the buyers felt satisfied with this level, and the price could not rise above this level. So this level is a strong resistance level that pushed the price back down. Okay, so at every level, whether support or resistance, there is a corresponding level on the RSI. Okay, so you can see at this level, this support level, the corresponding level is this level here on the RSI. So at the level up there, there's also a corresponding level on the RSI. So what happened? The divergence is when the levels do not follow the same transition. Okay, so the price on the candlestick chart moved from a lower high up to form a higher high. Okay, and so those levels, the lower high and the higher high level up there, do not agree with the transition on the RSI indicator, meaning the lower high formed the higher high, okay, and the higher high formed a lower high. As price goes up, as the price of an asset rises, the RSI is expected to rise. Okay, and because the RSI did not rise as the price rose, it tells you that there is a shift in momentum, and it tells you that that move up is a false move, because the market momentum dropped from this level to this level. So the RSI divergence is a drop in the market momentum. It tells you that the uptrend is about to end. Okay, so it tells you that the uptrend is about to end. Okay, so you have to be, you look down at the RSI level. Okay, so whenever you see it, the higher high is forming a lower high. You can see that is a great uptrend, you know, and the divergence, it doesn't form, it doesn't agree with the chart. Okay, you can see the chart is making a higher high. You can see it. The chart is making a higher high over there. You can see it. You can see the great the Marubouzu candle over there. Okay, and you can see that the chart is actually making a higher high, and but the RSI does not agree with it. The RSI is forming a lower high. Okay, you see the lower high on the RSI. You see that level over there. You see the level over there, right? Okay, so you see the level over here also. So you see that the higher high from the chart, you can see it. There's a higher high, the higher high. Okay, that level is higher. Does not form a corresponding higher high on the RSI. You can see whenever that happens, it's called a divergence. Okay, so once again, you see, I repeat, the higher high, okay, on the chart is not producing the higher high on the RSI. Okay, producing a low. You can see it. This level is higher than this level. You can see it. So that level, the higher high over there, you can see it. The higher high over there is higher than this level. Okay, but if you trace it down, you will realize that it doesn't agree. Okay, so it's not producing, it's not conforming to what the chart is saying. Okay, so let's look at another one. This is also a divergence in a downtrend. Okay, so this is a divergence in a downtrend. You can have a divergence in an uptrend, and you can also have a divergence in a downtrend. Okay, so you are also looking for the same thing. You can see that level over there. You can see the level over there. It's the level on the RSI. Okay, you see the chart is producing a lower low. You can see it. That level is higher than this level. You can see it. The chart is producing a lower low. Okay, and the chart is producing a lower low. You can see it is very clear. Okay, but the RSI is not producing a lower low. Okay, so you see the level over there, that's the lower low. You can see the level, and that level is higher low. This level is the lower low. That level is the higher low, lower low, higher low. Okay, you can see, so the lower low is producing a higher low over there. You can see the arrow, the red arrow. You see the lower low is producing the higher low over there. See the red arrow. Okay, so you have to really understand this concept. Okay, you see the lower low is producing the higher low. Okay, so it's called, whenever this happens, it's called a divergence. Okay, so divergence is, you will hear more of divergence than any other thing. Okay, so now let's move on to the support and resistance lines. Okay, so the support and resistance lines is, there are areas of resistance, and the lines are superheroes. Okay, they indeed make the difference. Okay, can you imagine a car without brakes? Okay, so support and resistance lines are areas of great interest in the market. These areas reflect disagreement with the price level. So for the purpose of this training, we will use the pair of jeans concept. Okay, and that is a concept created by binary options university. Okay, so let's go straight to the pair of genes concept. Okay, so this is a concept. It is a way of memorizing and understanding the resistance and support levels. It's a way of drawing accurately these levels, okay, on the chart. Okay, so if a good mastery of the pair of genes concept will enable you draw the support and resistance lines like a pro. Okay, so the support and resistance lines are scattered across the chart. Okay, and so you must learn to draw these levels accurately well, because they are potential exit and entry points. Okay, so the concept is built on the premise of buying and selling. Okay, at a certain level the price is not attractive for buyers again. Okay, so you can see this level. This is the first level, number one. Okay, the pair of jeans is trending because it is the latest design and ladies are willing to pay any amount for a pair. Okay, so at this level the pair of jeans is very attractive because it's trending. Okay, they are willing to pay any amount for it, and you can see the ladies are pumping in money, and they are actually buying this particular asset. Okay, they are buying a pair of jeans, and you can see, because the demand is increasing, you can see what's happening to the share price. Okay, so the pair of jeans is trending because it is the latest design and ladies are willing to pay any amount for it. Okay, you can see it. So because ladies are willing to pay any amount for it, the vendors increase the price of the pair of jeans as the demand increases. Okay, so this is a normal reality in life. When there's an increase in demand for something, there will be an increase in price. Okay, so you see, in this case, you can see the pair of jeans is very lucrative, and because it's very lucrative, the vendors capitalized on that fact, and so because they found it so lucrative, and the pair of jeans is trending and it's moving fast, the vendors have decided to increase the price of the pair of jeans, and you can see the movement from down up. You can see how far the price of the pair of jeans has moved. Okay, so because the vendors have decided to increase the price as a result of an increase in demand. Okay, so as demand increases, as demand for the pair of jeans increases, the price also increases, as the vendors will ultimately increase the price of the pair of jeans. Okay, so when it gets to a certain level, okay, the ladies will feel they won't feel satisfied with the price anymore, because they will feel that particular pair of jeans, although it is still trending and it's still the latest fashion, they feel that the pair of jeans is overpriced. Okay, so when it gets to that level, the ladies will begin to resist buying. Okay, and because they consider the pair of jeans too expensive. So you see that level over there is called a resistance level. Okay, so this will help you draw the resistance level very well. Okay, so whenever you see something like this, just imagine the pair of jeans concept. Okay, just imagine the pair of jeans concept and draw a line over there. Okay, so that is a line of great resistance. You know, it is an area where the ladies have stopped buying the pair of jeans. You know, you can see the long wick, you can see how long the wick, you can see that level. Okay, then there's a sudden reversal at that level. It is indicative of great resistance. Okay, and so the ladies stop buying until the vendors reduce the price back to a certain level. Okay, that level where the vendors reduce the price to is called a support level. Okay, you can see over there the price moved from the resistance down. You can see this level down there over there. Okay, so that level is called the the support level. Okay, it is a level where the vendors reduce the price to stimulate sales. Okay, so you can see as soon as the price hits that level, the support level, the vendors have reduced the price to that support level. The ladies picked up interest and they started buying. Okay, so the ladies begin to buy again, once again, because they consider this pair of jeans competitive. They consider the pricing competitive and attractive. Okay, so at that level over there, the support level, the ladies found the pair of jeans to be a good bargain. You can see the resistance level over there. Okay, the ladies stopped buying over there, and so the vendors dropped the price back to the support level. You can see that level, that's the resistance level. So the vendors dropped the price to the support level, and because the price became very attractive to the ladies, you see the pricing, the low pricing stimulated or triggered a series of buying episodes. You can see it triggered the buying move. You can see there is that level, from that support level over there. You can see that the ladies started buying. You can see there's a push up. The price went up straight. The price went up as the vendors, okay, increase the price once again. Okay, they increase the price once again when they sensed a great demand in the market. Okay, so as a result of the great demand, the vendors increased the price once again. Okay, because they could sense that the ladies were willing to pay more. As a result of the demand, they could sense that the ladies were willing to pay more, because they considered the pair of jeans to be trending, to be a trending fashion. Okay, so because the pair of jeans is trending, the ladies are willing to even pay more than before. Okay, so you can see they were paying more, and the prices shot up. The prices went up to that level over there. You can see that is a higher high. According to what we discussed previously, you can see that is a higher high. That is another level entirely. Okay, the level is higher than the previous resistance level. Okay, so that is another level. It's a great resistance level. That is one level that the ladies started picking up. They started generating resistance again. So the ladies stopped buying over there, and they resisted buying at that level. Okay, because they consider the pair of jeans outdated. Okay, so that level is called the resistance level. Okay, and so you can see the price crash down. Okay, the vendors reduce the price once again to try to stimulate sales once again. Okay, but this time around you can see that the ladies are no longer interested in this pair of jeans again, because already they've considered the pair of jeans outdated, meaning the pair of jeans is out of fashion. It's no longer trending. Okay, so the ladies, even the reduction in price could not stimulate more sales. Okay, so the price of the pair of jeans crashed. Okay, the price of the pair of jeans crashed. So from that resistance level, you can see what happened to the price of the pair of jeans. The pair of jeans crashed. The price crashed because the ladies were no longer interested in the pair of jeans, and it crashed once. Okay, so you can see the pair of jeans crashed from that level and went down. Okay, so from that level over here, the higher high, the price crashed down. The price crashed down further as the ladies were no longer interested.